Hello and welcome to Money Markets and More. My name's Dominic Frisby, and today I wanted to try and explain a shift of enormously significant proportions which is taking place. I think in magnitude it could prove as significant as Bretton Woods in 1944 when the dollar became the de facto global reserve currency, and as significant as the Nixon Shock of 1971 when the US abandoned the last vestiges of its gold standard. This shift is going to shape the global financial landscape over the next few years. And I think you need to understand what is happening. I'm trying to understand what is happening so that you can position yourself and your family. I'll do the same. You may even be able to profit from the transition. But I'm going to try and explain US dollar policy, what's going on, and more importantly, where it's going. So, as we know, America wants to bring manufacturing back on shore. We all know this. US President Donald Trump has said it repeatedly. His VP J.D. Vance has said it. So has his Treasury Secretary Scott Bessent, who keeps reminding us that now is the time to prioritize Main Street over Wall Street. And part of the reshoring of US manufacturing involves tariffs, as we all know too well. Part of it involves weakening the US dollar, so as to make US exports more competitive. And again, Trump, Vance and Bessent have all said it. However, there is a problem, and that problem has a name: Triffin's dilemma. Now, you might think it's an advantage to issue the global reserve currency. You can issue dollars, everyone else has to work for them. You can create dollars. The others have to work for them. French called it America's exorbitant privilege. But this was a status the US engineered for itself during the Bretton Woods agreement that determined the monetary order at the end of World War II. What has happened, however, is that it's made the US fat and lazy, especially since 1971, when the US abandoned the ties of the dollar to gold. To supply the world with dollars, the US must run trade deficits. That's to say, it must buy more than it sells, and persistent trade deficits over time have eroded its industrial base. Factories and jobs have gone offshore, and foreign nations have used their profits to invest in US capital markets and its debt. So, meanwhile, financial markets, Wall Street and all the rest of it, has grown and grown as America has financialized. And the Trump administration gets this in a way its predecessors did not. Vance has actually called the US dollar's reserve status a tax on American producers. And as this process has continued, the actual credibility of the dollar itself is being called into some doubt. Trump wants to revitalize America's Rust Belt, but there is more to it than that. Because during COVID, as the curtains pulled back, the extent to which the US had been operating with its trousers down was exposed. Excessive dependence on China and its supply chains for too many strategically essential products, especially in health, tech, and the military. Then, during the Ukraine conflict, NATO found itself unable to match Russian munitions production. So the US, in short, is struggling to produce critical goods. And it's why Trump keeps harping on, for example, about rare earth metals. The US is vulnerable. And the answer is to engineer a managed decline of the dollar as the global reserve asset. And by the way, if you're enjoying this video, please sign up to my Substack, The Flying Frisbee. That is the best way to get access to me, whatever I'm thinking. It's free, but if you want to get my hot investment tips, there are paid options you can upgrade to. That's at theflyingfrisbee.com. There is a link in the description. So this managed decline of the dollar was already happening organically. China, for example, has been reducing its holdings of US treasuries for some 10 years now. Quite gradually, although its US dollar holdings remain above $3 trillion. But meanwhile, China and many other countries along the Silk Road, all those Asian countries, have been increasing their gold holdings, and quite dramatically. In fact, it's my view that China itself has been understating its gold holdings by a factor of 4 or 5. It has at least 4 or 5 times as much gold as it says it does. If you're interested in that, you can read more about it in The Secret History of Gold, which has just come out and is getting amazing reviews. Destined to be a classic, said Money Week. The best timed book ever, said Merrin Somerset Webb. A must read, said Rory Sutherland. Available at all good bookshops. Buy yours and then post your review. Anyway, this process is known as de-dollarization. Just a few months ago, gold overtook the euro to become the second most held asset by central banks, while the dollar itself fell beneath 50% for the first time this century. Gold has also just overtaken US treasuries as a percent of central bank holdings worldwide. That is an extremely significant development. We're not seeing a move towards any other national currency as global reserve, and there isn't one that could take up that role, despite what the bureaucrats in Brussels might shill you about the euro. The yuan isn't ready for that yet. So the move towards the neutral but universal asset that is gold, that suits all the main players. Gold is neutral, and both the US, assuming it has the 261 million ounces it says it does, and China both have lots of it. American gold hasn't been audited in over 60 years, hence the doubts. But a gold revaluation would be a win-win for China and the US. A higher gold price would strengthen US fiscal flexibility, as I'm about to explain, while boosting Chinese consumers' wealth, which would encourage domestic consumption and reduce trade imbalances. And China, by the way, has been encouraging its citizens to buy gold since 2007. So there is the potential to leverage the US's 261 million ounces of gold reserves because they're currently marked to market at just $42 an ounce. And there are all sorts of different ways this could be done. There's an economist, Judy Shelton. She's proposed issuing treasuries that are in part backed by gold to offset the inflation or the debasement risk of the US dollar to make them more attractive to buyers. The other possibility, which has gone from, as Bessent put it, we're not doing this to we are not doing this yet, is more sudden, but it's to revalue gold from $42 to the current price of $3,500 an ounce, which would create 900 billion of reserves, something like that, without having to incur any extra debt. And that would help with the US's current fiscal challenges. True interest expenses, I read, including entitlements and Veterans Affairs, currently exceed 100% of Treasury receipts. In short, the US administration is leaning into a weaker dollar and the neutral reserve asset that is gold to rebalance trade and rebuild domestic industry, even at the cost of short-term economic pain. You must own some gold. If you're interested in buying gold, these are interesting times. I urge you to. I'll put a link in the description to my recommended bullion dealer, which is the Pure Gold Company. If you call them up, tell them I sent you. But you have to own some gold, maybe a bit of silver as well. Bitcoin, as the world's best neutral digital currency, is also going to have a role to play in this. I know some of you don't like it, but the US is quite happy with that situation, as evidenced by its pro-Bitcoin rhetoric. At the national level, at the corporate and individual levels, the US has a lot of Bitcoin. America itself, 198,000 coins, the most of any nation. Strategy has 630,000 coins. Many other companies also hold, and something like 15 to 20% of US citizens are thought to own some Bitcoin. And of the eventual 21 million supply, of which maybe 15% has been lost and another 1.3 million are locked up by Satoshi Nakamoto and will never appear, he's almost certainly dead, a hefty chunk one way or the other lies in the US. Which brings us to the recent Genius Act. Now, this effectively nixed CBDCs. The Federal Reserve Bank is not allowed to issue them, just as, irony of ironies, the EU's Christine Lagarde was planning to phase them in. Lol. However, it supported stablecoins, that is, coins backed by dollars, as a private sector alternative. Now, the more Bitcoin grows, the more the stablecoin market will grow, and vice versa. And today, roughly half of the entire US dollar stablecoin market is invested in US treasuries. It's only about 2% of the overall treasuries market, although Tether is the world's 7th largest buyer already. But as this stablecoin market grows, so will demand for treasuries. The market's small, but it's growing rapidly. 2035 projections include 500 billion from Europe, from JP Morgan, 2 trillion, says Standard Chartered, 4 trillion, says Bernstein. That's more accurate in my view. But if the stablecoin market meets these growth projections, says the Kansas City Fed, it could lead to a substantial redistribution of funds within the financial system. In other words, the stablecoin market is going to help the US fund its debt, just as other nations move away from treasuries to gold and Bitcoin. Clever. Now, gold might suit the US as a neutral currency, but Bitcoin suits it better, especially if there are complications surrounding the Fort Knox gold, which it seems there are. Why has there not been an audit yet? So a few years from now, it is likely there's going to be almost like a showdown between gold and Bitcoin in the battle for primary reserve asset status. It's unlikely to be both. I expect governments will favour gold. They have lots of it. Tradition is on their side. Eternal Gold has a track record that's unrivaled. Everyone naturally understands gold, but it is an analog asset in a digital world. Bitcoin's much more practical. Which will win out? Practical, digital, or impractical analog? This is a contest that's on its way, still a way off. Though, for now, all roads lead to gold and Bitcoin as the world de-dollarizes. So own both, is what I say. Needless to say, the UK is absolutely clueless in all of this, having sold 2/3 of its gold in 1999. The FCA made it near impossible for UK citizens to buy Bitcoin. Word is the Chancellor is now planning to sell our Bitcoin holdings, though as these are confiscated, it's legally problematic. But the UK has recently, meanwhile, overtaken China to become the largest holder of US treasuries in the world after Japan, just as everybody else is dumping. It is making no attempt to buy any gold either. We really have clueless clowns running the show. Meanwhile, with the threat of AI and automation to America's jobs, the world's jobs, but especially in driving, where millions work and self-driving is quickly starting to take off in the States, there is the risk of mass unemployment coming quite quickly, and with it, plentiful defaults on mortgages and loans, which could force the US into another money printing episode, which is going to drive inflation and provide yet another reason to own gold and Bitcoin, which cannot be debased. So, in short, the US dollar will weaken significantly over the next 3 years. The pound is a basket case. National currencies are not stores of wealth. Gold and Bitcoin are. Own both as the Trump administration addresses Triffin's dilemma through a managed dollar decline. They will use gold and potentially Bitcoin to restore US industrial and military strength. That is the shift that is taking place. You have been warned. I think that's quite an important video, macro piece, but thank you very much for watching. I hope you enjoyed it. Please sign up for my investment Substack, The Flying Frisbee, flyingfrisbee.com. Buy my book, The Secret History of Gold. Links to both are in the comments. I'll be back with another video very soon. Until next time, thank you very much for watching. Goodbye.